Hi, welcome back. You're watching MF Corner. Anubhav Srivastava, partner and senior fund manager at Infinity Alternatives, joins in to talk about the new rules that SEBI has announced for passive funds. So we have spoken about the categories, but Anubhav, the big problem that we used to have with ETFs was the liquidity on the exchanges. Do you think this is about to change that? Can we see higher volumes?
I think that would be the biggest change that we will see out here, in addition to the move on debt funds. So earlier, what would happen was, so long as you were in a creation unit size, which is the minimum amount of money that is required to create a full basket, as defined by the AMC, you could go to the AMC and buy or sell that basket directly to them. Now, what the new rules say is that you cannot do that in any amount that is less than 25 crores. Which is a pretty big benchmark. It's also one that, let's say, people like Bharat Bond anyway do, so they're not really affected. What this does is it makes sure that anybody who's not an authorized participant, which is an authorized participant or a market maker, cannot do it in under 25 crores. So I'm guessing the only person that is exempt from all of this is the big EPFO money that comes in. Everybody else has to trade on the exchange, which means that anybody who's buying or selling will now need to go to the exchange, which will drive all of the HNI buying and selling, all of the corporate buying and selling, which would earlier come into the AMC directly, straight onto the exchange, which is actually quite a significant liquidity that would get pulled from the exchange. And unfortunately, what would then happen is that retail investors would end up paying a significant, either a spread or a premium or a discount whenever they went to the exchange. And as you rightly said, that would not be conducive to retain their interest in the product. Similarly, advisors would have a big problem if they were trying to trade or advise on trades. They would not be able to get the price they were looking for, because this would wildly vary from the indicative NAVs that were out there.
Right. But, Anubhav, they have mentioned two things. One is the liquidity measures and the other is a liquidity window. I mean, can you explain, what is the difference over here, if any?
Right. So the liquidity window is when you don't have any trading on the stock exchange on that counter. Now, this might happen because the market is not good for that specific ETF, or there has been a structural breakdown in the underlying market, or any of those things. So what SEBI says that A, if you do not have any quotes, any bids, that is, right? B, if there is not, if there's no bid for, let's say, half the creation unit. In that scenario, you can actually go to the AMC in this under 25 crore limit and redeem directly. All transactions will then be treated much at par, much in line with the typical mutual fund investments. And you can then, get your money out of the market if there is a freeze, if there's a temporary freeze, or those kind of things. Of course, this needs to happen for a week, and then the AMC is bound to open this up. Now, this is always there. But it was a condition that was imposed on every single ETF filing that was there. But now, of course, it becomes a mandatory thing for all ETFs that are out there. Okay. So that's what we mean by liquidity windows. It's a temporary liquidity window that opens up for investors to go and redeem their units directly with the AMC.
Okay. And likewise for, tracking error and tracking difference?
Right. So again, tracking error and tracking difference was something that was sometimes published, sometimes not published, and there was a huge problem with people didn't know how to calculate it and so on. So what now SEBI says that, look, if you need to decide between two passive managers, tracking error is the way to do it. So first of all, your tracking error past 1 year rolling data cannot exceed 2%, and you have to publish it. All right. If it does exceed 2%, then the trustees must be made aware, because they look after the investor's interest, and they need to then they need to be told as to what measures are being taken to do this. This is to be obviously disclosed on a daily basis, because that's how we do it. Tracking difference is the effect of tracking error. So tracking error is great. So are you following it closely or not? Tracking difference is what happens to the fund that is badly managed or poorly managed for a whole year, on a relative basis. So now the tracking difference is the difference between the returns on the benchmark and the returns on the ETF or the index fund needs to be disclosed on a 1, 3, 5, and 10-year or 10-year levels on a monthly basis.
Okay,
and
understood.
The average for the last 1 year cannot exceed 1.25%. Now, this same thing applies for debt funds on the passive side and debt ETFs, and any deviation needs to be reported to the AMs, to the mutual fund trustees, and they then need to be told what is the corrective measure that is taken. Okay. I'm guessing that if there are wild tracking errors, SEBI is not going to look kindly on somebody managing it poorly.
In any case, as of now, the tracking error, tracking difference is not publicly known, right? I mean, if you know, you know. There's no way to check what has been the historical record. But what about this thing on INAV, indicative NAV? Isn't it already being done that real-time NAV is reflected for ETFs?
You're absolutely right. But the problem with INAVs has always been that it's sometimes published, sometimes not published. It wasn't mandatory to do this on the company website. So if you're trading 5 ETFs, you literally have to keep 5 browser windows open and then make sure that those things are available for you to trade on and to figure out whether there's a premium or a discount. Secondly, they were all running at different, delays. Somebody was running at 20 minutes, somebody is running at 10 seconds. So you're not really comparing anything. So what SEBI now says is that you must publish this at a minimum 15-second snapshot on the exchange, which means the exchange feed should give you the INAV as well, which means that the platform that you use for trading, that shows you the INAV. And for debt, it needs to be published a minimum 4 times a day because it's it's got lower trade amount of trades. But gold, silver, and international go on a best effort basis.
Okay, fair enough. Final question is on this whole thing of passive ELS, which have now been allowed. We understand that AMCs must choose either an active or a passive fund. So one is that how effective will a passive ELS be? And second, what about those AMCs who already have active ELSS schemes going on? I mean, what is the option for them?
I think they can do both, in my view. You can launch passive ELSS schemes as well. And one of the great advantages of a passive ELSS scheme is that, in a 3-year, you could technically go through a specific cycle. Now, when we talk about passive, it means beta, and it also means smart beta. So, and smart beta and beta are both, longer term investments. So let's say somebody were to do an ELSS SIP for a full year. I would think that without a fund manager risk, and especially these are very long-term investments, a passive index fund would be a fantastic development for anybody trying to save, as well as trying to get that tax benefit, which is a kicker on this. So passive ELSs, I think as a category, it simply forces investors to stay invested. I think that's a good thing. It also does away with fund manager risk over a longer period of time, because there's a 3-year lock-in and so on. And so this is how most AMCs would like to do it. For somebody who's not doing any passives or ETFs right now, from an AMC perspective, this might be a great way for them to dip their feet into that space and start to get their systems and operations sorted to maybe then go into a wider ETF and index fund launch.
Understood. Anubhav, thank you very much for explaining these new rules to us. So they should, I think, come into play on the 1st of July. So let's wait and see how the real-time impact is. But as of now, a big boost for passive funds.